with the NASDAQ down by almost 10% since the beginning of the year and the S&P 500 by almost 6%, you have some pretty serious opportunities on the market. And in this video, I want to show you 3 stocks that I'm actively buying, that I'm considering as well buying for one of them, that I believe are undervalued. I believe that they can provide very good shareholder value for the next 3 to 5 years, and that you should potentially buy if you want to outperform the market. So I will not talk about Google or Amazon because they have been widely covered in other videos by other YouTubers. I will focus on 3 other companies that I'm almost sure you know them, but they represent really great opportunities right now. So let's go to the first one. The first one, you probably know it, is Novo Nordisk, okay? The reason why I believe it's a great opportunity is, first of all, when you look at the forward PE, the median, okay? The median for the last 10 years was around 23. Now we're at 17. A forward PE of 17 is almost the lowest level that we've seen in the last 10 years, okay? Last time we've seen down was 15. So 17 is really good for a business that is growing and a business that has this kind of margin. Because if you look at the margins, okay, so the operating margins for Novo Nordisk are 48%. You have a business with operating margin of 48%. That is not really usual for a drug business, okay? 48 is increasing. Since the last 10 years, it doubles. It doubles in the last 10 years, so it's huge. You have a return on invested capital of 32%, which is also very high. Yes, it's decreasing, but it's very high. If you compare to Eli and Lilly, you have operating margin at 40% now, 38.9, but generally it was around 30%. So it's 10% and 10 point higher than Eli and Lilly, which is very good. And same with return on invested capital, it had been declining, but still, now since 3 years, it's growing again. It's still higher than Eli and Lilly. While on the other hand, for the PE ratio, everybody tends to think that Lilly is a way better deal. It had a way higher PE ratio, forward PE of 34, okay, while the median is 21 here, 17, while the median is 22.8. So let's go in the numbers. You can see that we'll check the revenue. The revenue increasing rapidly, increasing seriously by almost 12% per year for the last 10 years. And it's expected to grow for the next 3 years by 16% per year. It's very big growth for a revenue. For companies this size, it's really good. They're really on a good market. If you check now at the operating income, same, huge growth, 13% per year, expecting to continue to grow. Okay, a very good growth is expected for this company. 15% per year expected growth for the operating income. When you look at the net income, same, you have a very solid growth, almost 13% per year. It's a company that is growing really, really rapidly. And the EPS, because they do a bit of buybacks, same, growing 14% per year. So by buying Novo Nordisk now, you have a dividend of almost 2%. I would prefer that they do more buybacks with this money, and a potential revenue growth of 19% for the next 2 years, per year for the next 2 years, and EPS growth for the next 2 years, 22%, and long term 15%. So it's really good. Let's have a look at the valuation, okay? So now the price is around 417 Danish crown. Let's say they will have in 3 years approximately a P ratio of 20. Okay, now the forward P is 17. It will go a bit up. Let's say it's really undervalued now. It will go a bit up. It will go to 20. Okay, if they have 14% growth rate and do 0.5% buybacks, you could have a cumulated annual growth rate of 14% with this company. 14% with this. Analysts expect 22% growth. The CEO expect 20% growth for 2025 and probably around 20% for 2026. So they expect big growth. So if they have 22% growth, like the analysts tend to think, okay, here, 22.3 for the next 2 years. So if they have this, you have a company that could return 22% per year, which should outperform the market, okay? Now let's take some margin of safety. Let's put here 15%. You will do 15% per year. 15% per year. It's a very solid result. It's a very solid performance. So that's why I think Novo Nordisk now, it's an interesting stock to buy. It's a very good company with very good business. They have very good numbers, very good margins. The problem now is this competition on the obesity market. Apparently they will not be the leader here. They are a bit late on some drugs. Eli and Lilly have better drugs than Novo Nordisk now on this market segment, but yet Eli and Lilly will not have a monopoly. It will be a duo, trio, we don't know how many companies will be there, probably more than 2, but yet it's a huge market expected to be $100 billion in the next few years. So yes, there is a big opportunity, in my opinion, on Novo Nordisk. The second one I want to talk about is Evolution AB, okay, Evolution Gaming. They publish online gaming for casino, okay, they sell this, it's a B2B business. They have a very, very good track record, okay. They also have amazing revenue growth, you can see 45% per year since the last 10 years. It's expected to grow by approximately 8% per year for the next 3 years. So they have a good growth here. If you have a look at the net income now, net income growing 58% per year, and it's expected to grow for the next 3-4 years by 5% per year. So a bit less because they have some problems they're facing right now. So analysts are a bit down with this company because they have some cyber attack in Asia that don't allow them to grow correctly. They need to invest a lot to get into the United States market because you have some restriction to enter here. But yet I still believe this company can be a great opportunity, and you will understand why with the value. When we look at some other numbers, like we'll check at the ratios. If we go to the margins, we have operating margins for the last 10 years, which was it's 64% growing. It's almost tripled since the last 10 years. Amazing margin, 64% operating margin. It's huge. I don't know really if you realize it's huge. It's more than Google, okay? It's more than Alphabet. Return on invested capital, you have 29%. It decreased here since they did some acquisitions, okay? But it's growing again, 29%. They are really doing well with the money that they have. And they are doing very smart buybacks as well, okay? If we can look at the buybacks that they've done some pretty solid buybacks. Let's go to income statement, total share outstanding. So here they increased, since this they decreased, but 2023 to 2024, they've been more accelerating the buybacks. The reason for that is because they think the stock is really cheap. If we go to some valuation now, let's have a look. They expect to grow the EPS by 5% per year for the next 2 to 3 years. So let's go to this. This is the last earnings, okay, the last net income. The PE ratio, let's say it will be 15. The average for the last 10 years was 30. Okay, so let's put 15. Now it's around 12, 11, 12. Let's put 15. The price is around $70 for now. Let's say they will have a growth rate of 3% per year for the next 2 to 3 years. And the total share outstanding, they will do 2% buybacks per year. You will do 15% per year. With these numbers, you could do 15% per year. Now let's say analysts have been too pessimistic. You don't have this. You have a growth around 10%. You will do 23% per year. Okay? So I prefer to stick with a more conservative approach. Okay? Let's say they will do 2% per year. You still do 14%. Okay? So I think it's a very, very good quality business. Plus, you have a dividend that starts to be very interesting. It's 4% yield now. So yes, The Swedish tax is not really nice with dividend. I think you have 35% withholding tax, but yet you have a very good dividend, a very solid dividend of 4%. Plus, I believe that they can grow correctly. And the EPS, a long-term growth rate for the EPS is 13%. So it's apparently just few years where it will be 2, 3, 4, 5% EPS growth rate and then back higher than 10%. So yeah, I believe this is a company that is really undervalued. The third one, start to be really as well undervalued, is ASML. ASML, same, great numbers, low debt, great return on invested capital, return on capital employed, return on equity, very good. Great margins as well, operating for 32% growth, 51%. The revenue is expected to grow by 13%, almost 14% for the next 2 to 3 years. The EPS by 22%, 19% on the long run. So yeah, very good company, very good machines that they have. Dave Kantesaria believes that they are 10 to 20 years in advance compared to the competitors, compared to the market and everything, that it will need 10 to 20 years at least for somebody to come to compete with ASML. So I believe it starts to be an interesting price. He only have 2% or 1.5% of his portfolio in the company. I don't really know why he don't buy more, because he bought around $800, I believe. So maybe he will buy more soon. We don't know this. I think it's that well because the price earning multiple is still a bit high, 32 now. The forward P is 26. Okay, let's be fair, it's a bit high, but it starts to look interesting. If you look, so here at the revenue, you have 18% CAGR for the total revenue. If you want to look at the net income, you have 18% as well. And of course, they plan to continue to grow like this. Now let's look at some ratio. So the P ratio, we want to see the average of this P ratio. You can see that it's historically kind of low now. Let's look at the median, and the median is 36. Okay, let's see the average. The average is 38. So 31 can start to look cheap. The reason I didn't buy is because for now, I'm not really comfortable with company with a P ratio higher than 30. I'm not very comfortable with this. So I did an exception with Amazon, but I don't know if I'm willing to do this exception with ASML. So I'm maybe waiting a bit that it go under 30, but 31 is fine. 31.6 is still fine. So it's still a company that you pay a bit expensive, but considering the monopoly that they have, the advantage that they have on every competitor, it kind of makes sense that they have this premium that you need to pay. When you look at the margin, operating margin are great, okay? They're growing 32% now. The return on invested capital is as well great and growing 24%. So yeah, it's a company, a great quality business. When it comes to valuation, the price now is around 610 euro. This is the last earnings that they have. This is a share outstanding. Let's say they will do 0.5% buybacks. If they have a growth rate of 16% for the next 3 years, you will have 13.75% performance. Let's have a look. What the analysts estimate for the next 2 to 3 years is between 19 and 23%. So doing 16% is fair. If we have 22% like they expect, it will be 19% per year, which is very good if it's almost 21 with the dividend, but let's not count the dividend because it's a bit, it's 1%. So it's a bit low, plus with the tax and so on. So let's focus without the dividend. It's a pretty solid performance. Now, let's say they do 19%, it will be almost 17%. So this is very solid, and we put a P ratio of 26. So we expect that it will not go back over 30. It will not come back to 36, which is, let's say, the average for the last 10 years. It will stay under 30 and stay around 26. So yeah, 16% on it. It's pretty interesting. So this is the 3 companies that I'm actively following. Some of them I already bought in my portfolio. ASML, I'm still studying more the business to see if I want to buy or no, or if there is potentially some better opportunities with some other stocks that could be cheaper in the same industry. But yeah, I'm pretty confident with those three. Let me know in the comment section what you think about those companies. If you have other companies that you're actively looking and think that they are pretty much undervalued now, you also have, of course, Alphabet and Amazon that I believe are kind of undervalued. Microsoft started to be at a good valuation as well. So yeah, you start to have a lot of opportunities on these markets.